All right, so it has been a while since I have made a video. And you know why? It's because we've been in the lab cooking up some cool new features for all the Velocity Banking loyalists out there. Now, if you already haven't done so, head over to our site, myvelocitybanking.com, and you will get a chance to watch a video that explains Velocity Banking if you're still new to it, and also to set up a free account. So you put in your information. Once you get the free account, you put in your income, you put in your expenses, you put in the debt you're trying to pay off, and then the Velocity Banking app works its magic and it tells you what to pay, when to pay it, and then how much to pay. So today we are going to talk about the most requested feature that we have gotten in the last 6 months that we started, and that is the comparison against traditional banking versus Velocity Banking versus extra payments or versus any other method that you've heard of or that somebody's told you about to pay off your debt. So we now have a new feature right over here, traditional banking versus Velocity Banking. And we have broken it down to make it really easy for you to see how much interest that you are going to save doing the Velocity Banking method. And of course, interest equals time. And so if you shrink the time, you obviously pay less interest. So we're gonna also show you how much time you're going to save as well. So let's get right into it. We're gonna use Joan, our tester, our test user, get her info. So here's Joan. She makes $1,500 every 2 weeks. It goes right into her bank account, and hopefully she has set it up that it goes right into the line of credit if she has one that she's going to use to do Velocity Banking. So $1,500 every 2 weeks. Now Joan also has a side hustle. Let's say her side hustle, because she's just starting out, she's only making $50 doing Amazon. She sells things on Amazon and she's making $50 a month. So this right here is her income, her expenses, and her cash flow, and we're going to go through the expenses right now. All right, so this is Joan's expenses. Nothing out of the ordinary. $300 for groceries every 2 months. Her phone bill, her cell phone, Verizon, $50 a month. Internet, $60 a month. MetroCard for taking the subway, $50 every 2 weeks. Netflix, of course, $10 a month. That's pretty much it. Pretty normal, not like crazy expenses. And so that is what makes a part of her expenses. Now let's get right into it. Let's get into the debt that she wants to pay off. So there's a house, $219,000. For this is the mortgage, about $1,700 a month, 4.95 interest rate. She got a Capital One card. She hasn't spent anything on it yet. It's got $20,000 limit, 19.99% interest rate. Scotiabank, personal loan, about $16,000. The bank has told her, or when they send her the statements, that make the minimum monthly payments of $67 and the interest rate is 4.95%. So after we enter in all that information, here's what we get. The cash flow is the important part. Let's take a look at this. $462 is her cash flow. So let's go back. Now we're looking at Joan. So here's what we got. The traditional banking, Joan would have paid $147,000 in interest, just in interest, versus the Velocity Banking method where she only pays $96,000. Here's another view of it. This red part is the Velocity Banking interest, and she's going to pay this much more interest if she went with the traditional banking method. So essentially, going with Velocity Banking saved $50,000 in interest. $50,000 in interest. That's what Joan is going to save over the life of paying off her debt, which is $235,000 in debt. Now let's take a look at how this actually happens. And it all comes down to the math, right? If she stuck with what the bank has told her in terms of paying off that personal loan, $67 a month, Velocity Banking, she would have paid that off like this. 2 years, done. Versus the traditional banking, 85 years. It would take her 85 years to pay off $16,000 doing what the bank wants you to do, which is why we at Velocity Banking always tell you the banks are not here to look out for your best interest. They're here to make money, which is fine. We just need to figure out a way to beat them at their game. And that's what velocity banking is all about. Now, let's look at the house. The house, $219,000, $1,700 monthly payment. Velocity banking, she would have paid it off in about 9 years. 8.67, let's round it up, 9 years. 9 years versus what the bank wants you to do, 15 years. 15 years versus 9 years. And that's why the interest you save is $50,000, because time equals interest. The shorter the time, the less interest that you pay. And that's with the power of velocity banking, because you're using your money over and over and over again to pay down these debts. The other question I always get, so Mr. Velocity Banking, what if why do I have to do all this? Why don't I just do extra payments to my mortgage? I'm gonna make, if I got a raise, I'm just gonna make an extra $100 a month payment towards my mortgage. Wouldn't that be faster and not have to jump through hoops and do all this velocity banking stuff? I'm glad you asked. Let's take a look at that. Let's take a look at what that would actually look like. So let's say everything stays the same. So the cash flow is for $462 right now. But let's say Joan's side hustle takes off on Amazon. Now she's making an extra $100 a month. Okay? So, and she's gonna put that extra $100 a month towards her mortgage, which she's gonna start paying more. So instead of $1,700, she's gonna have to pay $1,800. $1,800, and we're gonna do a save. We're gonna see her income went up, but the cash flow stayed the same, right? Because now she made more money, but that money she's got, she's gonna make extra mortgage payment. The old extra mortgage payment method. So let's go back. Let's take a look at what this looks like. What does this look like? This looks like almost the exact same, because it doesn't change. Because the way that the amortized loans are set up, sure, the time has dropped in terms of the personal loan that she got. That hasn't changed because we didn't actually do anything for that. But she did start making extra $100 a month payment for the course of the loan. And it's 14 years. It's still 14 years. 14 years. Extra $100 every month for 14 years. And I think you only knocked down about a year or two off the mortgage. All that payment, like an extra $1,200 a month, all that payment, an extra $1,200 a year, all that payment only saved you 2 years. Knocked off 2 years off your mortgage. Why? Because extra payments does not help you. Because the way that amortized loans work, it's stacked against you because the interest is front loaded. So that extra payment that you're making, it's not going towards principal, it's going towards interest. So you go, okay, Mr. Velocity Banking, what if I call my bank and I want to put that extra $100 towards principal? Yes, you can do that. But that's what the Velocity Banking method is all about. That's what it does, right? It says, hey, take your debt, chunk it all down, and based on your cash flow, you can start making extra payments. And anytime you do a chunk towards your mortgage, you make sure that that chunk is going towards the principal. Now, your extra $100 is not going to make that much of a dent in it. So the Velocity Banking method wins again. So we've already looked at the traditional method versus the Velocity Banking method. Velocity Banking wins. The traditional method versus Velocity Banking method versus extra payments. The extra payment is good. It's better than the traditional bank method, but it's not even close to the Velocity Banking method. You would have to make an extra, like $500 or $1,000 a month payment to actually catch up to Velocity Banking. You'd have to make a lot more payment to catch up to Velocity Banking. Point is, if you have that extra cash flow, if you got that extra income, you put it towards your cash flow, and you'd have to pay the Velocity Banking methods even faster. Let's take a look at that. Let's take a look at what that would actually look like. So Joan is still making that extra $150 a month because now, she's hustling and she's selling more. Great. Now, what if she kept the mortgage payment the same? She didn't change anything, but this time, $1,500 that it was originally. And so her cash flow, you can look at this, it's gone up by $100. Now, if she put that extra money that she was making towards her cash flow versus doing extra payments, here is what we would get. Here's what Joan would actually get. So this, as I was saying before, is the debt breakdown chart. It tells you what to pay, how much, and when, and how often, and where to pay from. So this says take your Capital One card, make this payment, this chunk payment, and every 12 months you pay off so you pay off that card, that chunk, you do another chunk, and so on and so forth. So what is the impact of increasing the cash flow? Increasing the cash flow, look at this. Increase the cash flow means you could actually paying down this a lot faster. So now it's 8.75 years. So you knocked off maybe half a year, maybe almost a year off by doing these extra payments, right? So as by increasing your cash flow by $100 a year. So this is what, and see how much interest you saved. Before you saved $50,000 in interest. Now you're going to save $70,000 in interest because you're making the payments and you're saving all that time. And time, as we know, time equals interest. So that is what we have rolled out. Take a look if you haven't already done so. Like I said, head over to the myvelocitybanking.com. Get a free account. Put in all your information, then see for yourself why the traditional banking method is dead and you should not be following what the bank says because they are not acting in your best interest. And you should try to do the velocity banking method the best you can because no matter what, it is going to help you and you're going to get out of debt faster. So if you found this video helpful and you like it, make sure you hit the like button, the notification bell as well, because then you'll know when I release new videos because we're going to be doing a lot of this. Comparisons. Showing, taking real users' information, walking it through, see how much money they can actually save using the velocity banking method. And of course, as we roll out new features, I will be bringing that to you again as well. So until next time, Mr. Velocity Banking signing out.